Okay, let's unpack this. Imagine, just for a second, needing trillions of dollars to build the world's low-carbon energy future.
Trillions. It's a staggering number.
It really is. And our source mentions that's the scale required globally. But here's the kicker. Over 90% of that money, it's not expected to come from governments.
Nope. It has
Yeah.
to come from private capital markets.
Which is fascinating, right? This huge energy transition basically hinges on, well, the nuts and bolts of finance.
Exactly. Harnessing global financial systems to fund these massive projects,
Mhm.
huge wind farms, sprawling solar facilities.
Right. So today, that's what we're digging into. How does that money actually flow? How do you finance something like a wind farm that doesn't even exist yet?
And what are the unique challenges, the specific financial tricks, mechanisms that make it all work?
Exactly. And guiding us through this, we're drawing heavily from Renewable Energy Finance, Theory and Practice, by Santosh Raikar and Seabron Adamson.
Yeah, great resource. They've got decades of practical, real-world experience baked into it. It's not just theory, it's how things actually get done.
hmm So our mission for you listening is to cut through that complexity. We want to pull out the key nuggets,
The core ideas, who the main players are.
the policies that shape everything for better or worse, and the actual structures that make these huge investments happen.
Get ready for some aha moments, hopefully,
Uh,
about the plumbing of renewable energy finance.
okay, so let's start right at the core concept for these big renewable projects, project finance.
Right. Project finance. If you've heard the term, you probably know it's different from regular corporate finance.
How so? Like how a big tech company might fund a new campus.
Totally different. In corporate finance, a bank looks at the company's overall health, its credit rating, its whole balance sheet.
Okay.
Project finance flips that. The key idea is non-recourse finance to the sponsor.
Non-recourse, what does that mean exactly?
It's crucial. It means the lenders, the banks providing the debt, can only look to the future cash flows generated by that specific project for repayment.
Wait, only the project, not the big company behind it.
Generally, yes. If the project fails, the lenders usually can't seize the sponsor's other assets. Their recourse is limited to the project itself.
Wow. Okay, that seems risky for the lender. They're betting entirely on this one single wind farm.
It forces an intense focus on the project's specific risks. The technology, the location, the contracts, everything about that asset.
I see.
And to manage this legally, these projects are almost always owned by a special purpose company, an SPC.
SPC, is that like a shell company?
You can think of it as a dedicated legal container. It's an entity, like an LLC in the U.S., created only for this one project.
Ah, okay.
Its only job is owning and operating that single project. This legally ring-fences the project's assets and risks.
Ring fences isolates it from the main company.
Exactly. Isolates it from the sponsor's other business dealings and, crucially, their other potential failures. Lenders really like this clarity.
Makes sense. And why go through all this trouble? What's the upside? Scale. The book points out project finance allows for raising huge amounts of capital. We're talking global transaction volumes, often over $400 billion a year.
Wow.
And it allows for really high leverage, high debt compared to equity, sometimes over 85% debt if the project's economics are solid.
85% debt. That's a lot.
It is, but it works if the cash flows are predictable. Now, it is more complex and can be more expensive upfront than just borrowing on a corporate balance sheet.
Because you have to analyze all those specific project risks.
Precisely. And figuring out who bears which risk, the developer, the lender, the contractor, the power buyer, that's a major detailed negotiation.
Okay. And the debt itself. The book mentioned bank loans are common, but there are other types too.
Yeah, bank loans are primary, often because they offer flexibility if things need tweaking later. But bonds are also used?
Bonds for a single project.
Yep, they can offer fixed interest rates for a long time, which is attractive. But they're complex to set up for these unique projects and harder to restructure if needed.
And insurance companies. You mentioned them too. Right. They become big players, especially in the private placement market for, say, medium-sized projects.
Yeah.
They need those long-term, steady income streams from projects to match their own long-term insurance liabilities.
Interesting. So, okay, we have this engine. Project finance, SPCs, non-recourse debt. But projects don't just appear out of nowhere. Policy must play a huge role.
Oh, absolutely critical. The book makes a key point.
Yeah.
There's often a market failure because fossil fuels historically haven't paid for their external costs. like pollution.
Right, the environmental damage isn't factored into their price.
Exactly. That creates an uneven playing field where renewables, especially early on, might need support to compete purely on cost.
So governments step in. An economist might say carbon
This is
tax.
the most efficient solution, yeah. Make polluters pay.
Yeah.
But politically,
Hmm.
well, that's often a tough sell.
Very difficult. So governments use other tools. In the U.S., a big one seems to be subsidies through the tax code.
Definitely. You hear about the production tax credit, the PTC, and the investment tax credit, the ITC, all the time.
PTC, ITC, how do they work?
The book says, from the project owner's view, they're pretty similar. Economically, they reduce the effective cost of building or operating the project. But how they work within the U.S. tax system created this really unique, complex feature.
Uh-oh, complexity ahead.
Yep, the need for tax equity investors.
Tax equity. Okay, that sounds important. What is it?
Well, the issue is that the project company itself, the SPC, often doesn't make enough profit, especially in the early years, to actually use these valuable tax credits. They don't have a big enough tax bill to offset.
So the credits would just go to waste.
Potentially, yes. So they need to bring in an outside investor, typically a big bank or corporation, that does have a large U.S. tax liability.
Okay.
This investor puts money into the project, not for a traditional equity return necessarily, but specifically to be allocated the tax credits and depreciation benefits to use against their taxes.
And this makes the financing structure complicated.
Incredibly, you get these intricate partnership structures like the fixed flip mentioned in the book or sale-leaseback deals.
Yeah.
They're legally complex ways to funnel the tax benefits to the tax equity investor while the developer still gets their share.
So it's like a special class of investor just for the tax benefits.
Essentially, yes.
Yeah.
And the book notes that because these investors have limited rights compared to lenders and are buying a tax benefit, this slice of the capital stack, the tax equity, is often quite expensive money.
Wow. So a big chunk of U.S. renewable finance isn't just debt and normal equity, but this whole other layer driven entirely by tax policy. That's quite a structure.
It really is. And it even leads to other things like back leverage.
Back levered.
That's debt taken out by the developer, secured against their equity stake in the project company, not against the project assets directly. It sits behind the main project debt and the tax equity.
Sounds risky.
It is riskier and therefore more expensive debt, often used alongside tax equity to help the developer finance their portion.
Okay, so that's tax policy driving things. What about policies focused on quantity, like making utilities buy green power?
That's your Renewable Portfolio Standard,
Yeah.
or RPS. Very common across U.S. states. Though the rules vary a lot state by state, the book shows it's a real patchwork.
Right, requiring utilities to get X% from renewables.
Exactly. And to prove they're meeting the target, they use tradable renewable energy credits, RECs, or sometimes called T-TRECs.
RECs, okay, I've heard of those, like a certificate for generating green power.
Pretty much. It represents the greenness, the environmental attributes. You can, in theory, sell the physical electricity separately from the REC. The RPS creates the demand for these RECs.
But are they stable?
That's a key point the book raises. REC prices can be super volatile. We're talking varying by a factor of 10 or more in some states within just a few years.
Whoa. So how do projects handle that risk?
Often, they don't have to directly. In many large project finance deals, the REC is sold along with the power under a long-term contract, the power purchase agreement, or PPA. So the project gets a bundled, stable price.
Ah, the PPA bundles it. Okay. And are there policies that focus more on guaranteeing a stable price itself?
Yes, definitely. Think feed-in tariffs, FOTs, and feed-in premiums, FIPs. These were and are widely used in Europe, particularly Germany early on.
FATs and FIPs, how do they work?
A FAT basically guarantees a fixed price per kilowatt hour for the renewable energy, usually for a long period, like 15 or 20 years. Maximum revenue certainty.
Very predictable then.
Extremely. A FIP is similar, but it pays a premium on top of the prevailing market electricity price. Both are designed to make projects very bankable by reducing revenue risk.
Okay, got it. So we have the structure project finance, we have the policies, tax credits, RPS, FITs. Who are the actual players making a deal happen?
Well, the book lays out the core ecosystem. You've got the project sponsor that's usually the developer, the one putting in the initial equity.
Yeah.
Then the project company, the SPC we talked about.
Right.
And, crucially, the off-taker.
The buyer of the power, usually a utility.
Often, yes. Or maybe a large corporation buying power directly. And their contract, usually that PPA, is called out in the book as the single most important contract in the whole deal.
Most important, why?
Because think about it. Without a reliable, long-term buyer promising to pay for the electricity, the project has no secure revenue stream. And without that, you can't pay back the debt.
So the bank won't lend the money.
Exactly. The creditworthiness of that off-taker is paramount. Lenders almost always insist the off-taker has a strong, investment-grade credit rating.
Makes sense. What happens if the off-taker does default?
That's a huge risk. The project might suddenly have to sell its power on the open, volatile spot market at potentially much lower prices that could easily sink the project's economics.
Okay. And since the debt is non-recourse, assessing all these different risks is vital. You mentioned technology risk.
Yeah, lenders hate surprises. They strongly prefer technology that's proven, reliable, bankable. Stuff with years of operating history. New, cutting-edge tech. Much harder to finance.
Understandable. What else?
Off-taker credit risk, obviously. But also things like transmission risk.
Getting the power from the wind farm to the people who need it.
Right. Connecting to the grid isn't always simple or cheap. The upfront interconnection costs can be substantial, sometimes requiring upgrades far beyond the project site itself.
Oh, wow.
And in some markets, like parts of the U.S. with locational marginal pricing, LMP, projects face something called basis risk.
Basis risk? What's that?
It's the risk that the price you actually get for your power at your specific connection point, your node, might be different, usually lower than the price at the main trading hub where you might have hedged your output.
So you could have a contract based on the hub price but get paid less locally.
Exactly. That difference, the basis, can eat into your revenues. The book mentions financial transmission rights, or FTRs, as one tool projects can buy to try and hedge this specific risk.
Man, the layers of risk assessment are incredible. How do they even predict the basics? Like how much power a wind or solar farm will generate? It depends on the weather.
It's all probabilistic. They use sophisticated models, years of weather data, simulations. The book talks about using p-values.
Key values, like in statistics.
Sort of. P50 means the generation level you expect to exceed 50% of the time, like the average. P90 is the level you'd expect to exceed 90% of the time, more conservative. P99 even more so.
So lenders would look at the more conservative numbers.
Definitely. They also factor in things like equipment degradation. Solar panels lose a bit of efficiency each year, maybe 0.5% to 1%.
Okay, so you model the generation, multiply by the price from the PPA. That's your revenue projection.
That's the core of it, yes. And based on those projected cash flows, lenders figure out how much debt the project can safely support using debt service coverage ratios, or DSCRs.
DSCR sounds like bank jargon.
It is, but it's fundamental. It's the ratio of the cash flow the project has available to pay debt service, interest and principal, divided by the actual amount due.
So a measure of the safety cushions.
Exactly. Lenders will require a minimum DSCR, maybe 1.3x or 1.4x, meaning cash flow is 30–40% higher than the debt payment. And they'll test this using conservative generation forecasts, like that one-year P99 case, or maybe a 10-year P50.
And the loan term matches the PPA term usually.
Typically, yes. The debt is sized to be repaid comfortably within the period of guaranteed revenue.
What if a project doesn't have a PPA for its whole life? Maybe it sells some power onto the market later.
The book calls those quasi-merchant projects. They often use tiered debt structures.
Tiered debt.
Yeah, like a safer, lower-cost senior tranche of debt sized against the contracted PPA revenues. And then potentially a smaller, riskier, more expensive junior or mezzanine tranche that relies on those future uncertain merchant market revenues.
Got it. And for valuing the whole project, is it standard finance stuff?
Pretty much. Discounted cash flow, DCF analysis, is the workhorse, forecasting all future cash flows and discounting them back to present value. The book also mentions LCOE.
Levelized cost of electricity.
Right. That's more a metric for comparing the all-in lifetime cost of different types of power plants, wind versus solar versus gas, on a per megawatt-hour basis. Useful for policy and planning.
Okay, let's shift focus a bit. The book also touches on areas maybe closer to home for some listeners, like rooftop solar, distributed generation.
Right, DG generation close to the point of use. Rooftop solar is the classic example. And a key policy enabler there is net metering.
Net metering, where you get credit for sending extra power back to the grid.
Exactly. How that credit is calculated varies, but it's crucial for the economics of rooftop solar.
And those third-party ownership models, TPOs, like Solar City back in the day, they seem to make residential solar explode.
They really did. The TPO installs and owns the system on your roof, and you pay them for the power via a lease or a mini PPA. It made it easy for homeowners, no big upfront cost.
Why did that model work so well for the TPO companies?
Several reasons. Economies of scale in installation and financing. But crucially, They could efficiently use the federal investment tax credit and depreciation benefits, like MECRS, which individual homeowners often couldn't fully utilize. The book notes they could even sometimes claim the ITC based on a higher fair market value rather than just their installation cost,
Ah, so they aggregated all these tax benefits.
and aggregated the credit risk of thousands of homeowners. They bundled these contracts and cash flows, which eventually allowed them to issue bonds backed by these payments, securitization.
Clever. But the book says that's shifting now.
Yeah. As the cost of solar panels themselves has plummeted, direct ownership through loans or cash purchases has become much more common. TPO is still around, but less dominant than it was.
And the book mentions an equity issue with net metering.
Yeah, the debate about whether rooftop solar customers, by reducing their payments to the utility but still using the grid, might be shifting the fixed costs of grid maintenance onto non-solar customers who are often lower income. It's a contentious point.
Okay. What about community solar?
That's where multiple people subscribe to a share of a larger local solar project, maybe built on a warehouse roof or a nearby field. They get credits on their utility bills.
Sounds good. Financing challenges, though.
The book points out a key tension. Financiers want long-term, fixed-price contracts for stability. Subscribers often want shorter terms and prices linked to the retail rates they pay, which can be more volatile. Bridging that gap is tricky.
Right, and battery storage. That feels like the next huge wave.
Absolutely. It's growing incredibly fast. The U.S. market alone is projected to be billions by 2024, according to the source. Storage is so versatile.
How so?
You can pair it with solar or wind to smooth out their intermittency, making them dispatchable like a traditional power plant. Or use it standalone for grid services, stabilizing frequency, providing backup power, shaving peak demand.
Does it stand on its own financially yet?
It's getting there, but it still relies heavily on specific policies and market incentives right now. Things like state mandates or opportunities to participate in wholesale electricity markets.
Any specific rules?
In the U.S., FERC Order 841 was important. It directed the grid operators to create rules allowing storage to participate fairly in wholesale markets. The book also notes storage might even help defer costly transmission upgrades in some cases by managing power flows locally.
Fascinating potential. We've focused a lot on the U.S. Does the book offer lessons from elsewhere?
Yeah, it touches on a few key international examples. Germany, for instance.
They were pioneers with feed-in tariffs, right?
They were. Got very high levels of renewables, later shifted more towards competitive auctions. The book notes that strong community involvement and investment might have helped lower financing costs there.
Any downsides?
Well, it was criticized for being quite expensive for consumers, and some questioned how much additional carbon reduction it achieved relative to the cost, given other overlapping EU policies.
Okay. What about a major emerging market like India?
Huge potential, huge targets, but significant challenges.
Yeah.
A major one the book highlights is the poor financial health of many state-level distribution utilities, the discoms,
Why is that a problem?
because they're the main off-takers for large projects. If their creditworthiness is weak, it's hard to get PPAs that lenders consider bankable, despite central government support.
So off-taker risk again.
Exactly.
Yeah.
Plus challenges in building out the transmission grid fast enough to connect all the new renewable projects. Financing costs are higher, but competitive auctions and low construction costs help compensate somewhat.
And one more. Chile.
Chile's presented as having a generally positive investment climate, bankable PPAs with credit-worthy utilities. But they ran into a big problem the book mentions: transmission congestion.
Too much renewable power and not enough lines to carry it.
Precisely. Especially in the north with great solar resources. It led to significant curtailment projects being forced to shut down because the grid couldn't take their power. That highlights that building transmission is just as vital as building generation. It took new lines to alleviate that.
Right. So, wrapping this up, we've really gone through the plumbing, haven't we? Project finance structures, the policy levers like tax credits and RPS, the critical role of PPAs and off-taker risk, the complexities of tax equity in the U.S., modeling, valuation.
And how finance works for distributed solar, community solar, the rise of battery storage, plus some international perspective, It's a complex machine.
It really is, but understanding this machinery, as you said, gives you real insight into how we actually build the energy transition,
Yeah.
how policy turns into power plants, how trillions of dollars get mobilized.
Absolutely. It connects the high-level goals to the on-the-ground reality of steel, glass, and copper, financed by complex contracts.
So here's a final thought for you, our listener, to chew on. We've seen how much this all relies on specific policies, how complex things like tax equity are, the volatility in merchant or REC markets.
Hmm.
Given all that, how does this financial machinery need to evolve? How does it adapt to raise the next few trillion dollars needed, especially if policies change, subsidies phase out, or new technologies mature? What needs to happen next in renewable energy finance?